Hi, I'm Jimmy. In this video, we're going through the basics of how to value stocks. So there's a bunch of different ways to value stocks. Things like using something like the discounted cash flow method or price to earnings, price to book value, price to sales. We could use asset-based valuation. There's all different types of valuation methods. What we're going to do in this video is we're going to go through the basics of each group, look at the pros and cons of each type of valuation method, what types of companies are best suited for different valuation methods. We're going to look at things that could be good for REITs or good for banks or good for small cap, large cap, fast growing, slow growing, things along those lines. And before we jump in real quick, I just want to introduce you to a website that we're actually in the middle of building. This is actually how we came up with the idea for this stock valuation video is we're trying to add a bunch of different valuation methods to our website. When the website first goes live at the end of the second quarter of this year, we're planning on starting with discounted cash flow, but we plan on eventually adding every type of valuation method out there to make it quick and easy to value stocks. So for the point of the website for example, this is Merck. Merck is a pharmaceutical company. Discounted cash flow works well for this type of stock. Here we could see that the fair value using analyst estimates for free cash flow. Here's how many analysts are contributing to each one of them. Well, using a 7.5% required rate of return, we get a fair value of about $127 per share. We might enter a stock like McDonald's. What is McDonald's worth? Well, same required rate of return worth $159. How about Lowe's? Is Lowe's undervalued? It looks like Lowe's could be undervalued using 7.5%. How about Home Depot? A stock like Home Depot. Apple's a stock that I've been watching recently. It's been playing pretty close to the fair value. It's jumped a little bit. It's up to 174 right now. But that's the point of the website. So the website should be up and running by the end of the second quarter. And if you'd like to sign up for the website, I will leave a link in the description below. And the advantage of signing up now before the website goes live is we're going to lock in the prices for everybody who signs up before the website goes live. So if you'd like to, I will leave a link in the description below as to how to sign up. But in the meantime, let's jump over and look at some of the different valuation methods. So first, let's break these valuation methods into three different groups. So the primary groups, when we're talking about the fair value of stocks, is if we're trying to come up with the intrinsic value, also known as the fundamental value. And basically what we're doing there, as we could see, is this is something like discounted free cash flow. The assumption is the business is worth today what all future free cash flow might be. If we were valuing a dividend stock, we might use something like the dividend discount model. Basically, what are all the dividends in the future we're going to receive? What are they worth today? Ideally, we want to pay less than that. Or there's the multiples models. That is something like price to earnings, price to book. The theory there is that stocks are worth what their peers should be worth, or what their own history says they should be worth. So if the group is trading at 20 times earnings or 20 times cash flow, well, then we want to pay less than that for our stock, whatever company we're interested in. Or the final group is something like asset-based valuation. This is particularly good for something like a real estate investment trust, which is basically real estate investment trust owns different real estate properties. Well, if you could value each individual property, what are they all worth together? If you can come up with that fair value, well, you want to pay less than that in the stock market. That being said, let's look closer at some of the options within each one of these and some of the pros and cons. So the first one, it's my favorite valuation method, and that is the discounted cash flow valuation method. So the basic idea of discounted cash flow is that if we could determine what future cash flows are going to be, well, what is that worth today? We want to pay less than that. Some of the advantages of discounted free cash flow is that, one, they're popular. Two, it's widely accepted among investors. Now, that's important because how you calculate discounted free cash flow, we'll show the formula in a second, but how we calculate discounted free cash flow is something that's been taught for a long, long time. This goes back to the days of Benjamin Graham, which was Warren Buffett's mentor. And the idea that we could calculate the present value of future free cash flow and we want to pay less than that today has been proven year after year and is widely accepted as a good way to value stocks. The advantage to that is that helps create somewhat of a floor in many instances for stocks that look like they could be undervalued. Now, one of the disadvantages to this is that the calculation is very sensitive to the inputs. So, of course, we're taking estimates for free cash flow going up the next few years, and those estimates are exactly what we're saying they are. They are estimates. By the very definition of that, estimates could be wrong. The types of companies we want to use discounted free cash flow for would be large cap stocks, stocks where you can see a steady relationship between free cash flow and something like revenue or profit. Ideally, free cash flow to revenue, if there's a somewhat similar relationship, for example, perhaps 20%, give or take, of revenue gets converted into free cash flow by whatever the company is. Well, if you can reliably project that out, that makes discounted free cash flow a very good valuation method to use generally. Usually it's better for large cap stocks. Think Dow 30 or S&P 500 companies. So many of the more popular stocks, discounted free cash flow works well with. Okay, the next one we have is the dividend discount model. Now, the advantage of the dividend discount model, it works very similar to discounted cash flow in that you're projecting out future dividends, but the advantage to it is that we are valuing cash flows that go directly to investors. So discounted free cash flow is free cash flow that the company gets to keep and decide what they're going to do with. The dividend discount model, the advantage there is that we're projecting dividends, which is directly going to our pockets. So it's really good for if a company has the value, if the company is paying out a steady amount of dividends, maybe not the same amount every year, but perhaps they increase it by 2% each year, 3% each year, whatever the number is. If those numbers are reliable, and if we can reasonably project those numbers out, well, the dividend discount model could be a very good valuation method to use. I've also seen people use this for something like a dividend ETF. Could be a good way to value it. Again, I did a video on that, on how to calculate that, if you're curious. Now, the disadvantage to this, just like discounted cash flow, this is a discounted cash flow type of calculation. Well, just like discounted cash flow, it is the formula is very sensitive to the inputs that we use. And a company could elect in the future to change their dividend growth. There's been many companies, for example, AT&T. Recently, they had their dividends for a long time. They were gradually increasing them every year. They made a big change in the business, and then they changed that dividend policy. Well, if we had calculated their fair value before they announced that change, all of it gets sort of thrown off. So something to keep in the back of our mind. Okay, now this brings us over to the multiples methods. So there's a bunch of different multiples methods. The most popular is the price to earnings multiple. When we look at the price to earnings multiple, well, here, the biggest advantage of it is that it's popular, easy to use, easy to calculate, and profit is often tied. Profit is often the key to value. So many companies, the fair value of that stock is directly linked to their profit. If they are more profitable, they should be worth more. If they're projected to be more profitable, they should be worth more. If they're barely squeaking out a profit, in theory, they should be worth less. Now, plus, the final one here is that empirical research, historical studies have proven buying low PE stocks has proven to do quite well. The disadvantage here is that almost any company, given the right economic environment, can have negative earnings. Immediately, negative earnings makes PE ratios not worth anything. Plus, earnings volatility, it hurts how useful it is. For example, coming out of COVID in 2020, well, a lot of companies struggled that year. Their profits either went negative or were way reduced. And because the numbers were way reduced, well, the volatility in those profits or earnings and profits are the same thing. Well, the volatility there makes the whole thing swing, makes the whole valuation method a tricky one to rely on. Plus, I think one of the more important ones is that whatever management chooses for different accounting methods, could be how they account for leases or how they account for inventory. Well, their choices in inventory can influence their profits. So it's a bit more manipulable, you know what I mean? It's a bit more influenced by the way management decides to account for their numbers. Now, they have to disclose how they're accounting for those numbers, but again, it's something we would have to pay attention to if we're really doing the research on it. Now, if we like the idea of something simple like this again works well with large cap companies. If we like the idea for this, but we don't like the concept of earnings being somewhat, management can play with it a bit, well, we could always use something like price to cash flow. Cash flow is a bit less influenced by management's decisions for accounting methods. It is still influenced, but not quite as much as profit is. So, like we said, that's one of the advantages. It's harder to manipulate. It's harder to manipulate than profit is. It's more stable than earnings per share. Really saying the same thing there. And over the long run, it is proven to be highly related to stocks that are consistently improving their cash flow. The price to free cash flow, if you buy it when it's on its lower end, well, those stocks tend to outperform over the long run. Now, one of the disadvantages is that if we use cash flow from operations, which is a very popular number to use from the cash flow statement, well, non-cash revenue and working capital changes are ignored in that calculation. Now, another choice that accounts for more of that is to use free cash flow. But now we have to decide between free cash flow and cash flow from operations. So if you were to find a number like price to free cash flow on a website, or when we get our website up, it will be very important to pay attention to how that's defined. Now, once we get our website up and running with the price to cash flow feature on it, that'll probably be in the second version of it. Once we get that up and running, we will be sure to clearly define how each of the numbers are put out there, so whatever we're comparing should be consistent. Don't take one number from one place and another from another number from another place and just assume they're the same. We really want to make sure the baseline numbers are the same. Okay, now another valuation method. That by the way, price to cash flow is good for large cap stocks, a lot of medium cap stocks. It works with pretty much any stock that has positive cash flow consistently, except for financial stocks. If we're going to go with financial stocks, price to book value is a much better valuation method to use. Now, the advantage is book value is cumulative, so that is something that will gradually build over time, and it can keep up. It makes the calculations much simpler. It's easy to use, easy to find. You can find book value right on the balance sheet of pretty much any company. This valuation method is great for financial stocks. Think banks, insurance companies, things like that. Companies with highly liquid assets. Now, once again, empirical research, which is historical research, has proven that if you buy stocks with a lower price to book value, they tend to do well. Now, with all of the valuation methods here, you have really two choices. Compare the company that we're looking at. In this case, I would say, let's say banks. If we're looking at a bank, you can compare it to the industry, the overall market, or their own history. I would focus on either the industry, if we're looking at a bank, either the industry and or the company's own history. So if we're looking at JP Morgan, price to book value works well with the JP Morgan. If we're looking at JP Morgan and they're trading at 1.5 times book value, well, if their average history is 1x, well, it's probably overvalued. If it's 2x, it could be undervalued. So that's sort of the advantage too of using their own history. If the industry is trading at 5x and they're trading at 1.5x, well, again, it could be undervalued. So we don't want to just look at a number, and I've seen people say, hey, if it's over 1, it's overvalued, or if it's under 1, it's undervalued. I've seen many banks that trade consistently over 1 or consistently under 1.5 for 20 years. So I would compare it to find some reasonable comparison, either the industry or their own history. I personally like their own history. That way you know what the company has done, and then ideally you buy it at least when it looks cheap compared to its own history. Another option, if we're looking at stocks that are not in the financial industry, but perhaps a smaller, faster growing company, something like enterprise value to EBITDA could be a very good valuation method to use. So the advantage here is that, one, enterprise value is the value of the entire company, not just the stock. So that it looks at debt, it looks at the total market cap of the company, takes into account the cash of the company. So it removes the financial leverage. Plus, EBITDA is usually positive. This is why this could work well with a company like Tesla, which perhaps their free cash flow to revenue relationship hasn't been completely established yet. So something like enterprise value to EBITDA could work very well for that type of company. One of the disadvantages to that is that if their working capital numbers are still changing, that's probably true with Tesla to some degree, although it is starting to stabilize a bit. Well, if they are changing, well, that can sort of distort the numbers in the near term. Sometimes we can use free cash flow to the firm. That's FCFF, is free cash flow to the firm, but that is often a bit more volatile. And oftentimes we'll know if we should use free cash flow, or because you could use enterprise value to free cash flow or enterprise value to EBITDA. Enterprise value to EBITDA is great if CapEx, that's capital expenditures, is about the same as depreciation. If they're about the same, then EBITDA could be a great number to use. Now let's pretend that the company we're looking at is too new to even have positive EBITDA. Most companies at some point were too small for that. Well, the simplest method would be something like price to sales. We could use enterprise value to sales if we wanted to, but price to sales gets us very similar. It gets us to a very similar spot. Generally, revenue stays positive, so that's one of the advantages. Revenue is tougher to manipulate than profit is, so that's an advantage. Not as volatile. Oftentimes you'll see big swings in profitability, but you might not see the same swings in revenue. This works with so many different types of company. You could use it for a financial company. You could use it for a bank or an insurance company or a small cap regular business that sells widgets. It is very comparable across many different industries. And ideally, of course, you want to pay as low of a price as possible compared to sales. And once again, historical research has proven that there is a relationship there. If you pay less for sales, you're more likely to outperform over the long run. One of the disadvantages is that margins are ignored. So a company, if there are two companies and they're exactly the same, and one company has bigger margins, the other company has smaller margins, this company should trade at a higher multiple. So this goes back to, it is very important that we do the research behind the stocks. Once we decide what stocks we're looking at, if we know the company we're analyzing in the industry has some of the best margins in that industry, well, don't compare them to the industry, since they should be trading at a premium to the other companies since they have higher margins. And then one of the last valuation methods, and this can be a really good valuation method that we're going to look at in this video. If there's any other valuation methods you want me to break down for you, please let me know in the comments below, and I'll be sure to make a video on all of them. And any ones that I've already created, I will have a link in the description below. But asset-based valuations are really good. Great for real estate companies. Great for, worked well for oil companies. Any company, if you think about like a gold mining company, well, if you could value the gold that they have access to in the ground, then in theory, you could value the entire company. Now, this is really good for coming up with the value floor, they'll call it. So let's ignore a gold company for a second. Let's pretend a company has cash. They have $100 million in cash and their business is falling apart. Well, if their business is falling apart, you know that they're worth at least $100 million. That's how much cash they have. They're worth at least that. So if a stock is really tanking, but you're going, wow, they have $100 million right now, the stock's being valued at $120 million. Well, the question is their operations worth at least more than $20 million? It could be a great way to identify a floor. Look at the assets. Now, the idea here is that we take assets and we subtract the liabilities. So we're taking cash and minus their debt. If they have $100 million in cash, but they have $100 million in debt, it doesn't do us any good. They might as well have nothing. So this is very reliable with short-term assets. Cash is a good example of a short-term asset. It's also super helpful, really almost necessary, if the company reports the values. So let's consider a real estate company. If the company will list the properties that they own, and if we could figure out a way to value those individual properties, we'll add those property values up, we have what the company should be worth, or at least the floor of what the company should be worth. Those values can oftentimes, though, one of the disadvantages, those values can be tough to find. So if the company doesn't give us some idea of what those assets are worth, it could be tricky to find. Plus, if they do list what the book value is, oftentimes the market value and the book value will be different. So that is something we want to keep in the back of our mind if we're trying to look at the value of a REIT or something along those lines. So again, those are the basic valuation methods, and I know I presented a lot of different valuation methods today. I think that one of the simplest ones to use is discounted free cash flow, price to earnings, price to sales. If those are the three that we mastered, we can use those in most situations. If we're going to go to banks, go to price to book value. If you want to sign up for our website before the prices go up, before the website goes live, again, it should be live by the end of the second quarter of this year. If you want to sign up for the website, I will leave a link right here. I'll leave a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.